Okay, so now we're going to look at how these new transactions are going to go down with the new accounts for a merchandising business. So you'll see here in the general ledger we have cash and bank, accounts receivable, merchandise inventory, sales tax payable, accounts payable, sales, sales return and allowance, and then we have our accounts receivable subsidiary ledger, James Bonner and Anna Rodriguez. So these are the accounts we're going to be using. Okay? All right. So on September 1st, we sold $300 in merchandise plus a sales tax of $18 on account to James Palmer. Our source document is going to be our sales slip of 101. Okay. So if you'll notice here in the general ledger, we have September 1st, 2017, normal like always. Then we have accounts receivable. Notice the / James Palmer. Again, this is because we have the subsidiary ledger. This will kind of come a little bit clearer when we add in the whole posting situation. Okay, and you'll notice the / here. You won't have to worry about that in your Excel documents because it's really kind of hard to do. And since accounts receivable increases on a debit, we are going to do a debit of $318. The $300 merchandise plus the $18 sales tax. Okay. Then we have a credit to sales because we earned revenue because we sold some merchandise for $300, and then we have a credit to sales tax payable for $18, and we have our source document, sales slip 101. Okay. Next transaction. Sold $600 in merchandise plus $36 sales tax to Anna Rodriguez on account. Okay. Same situation as before. This time you'll see accounts receivable / Anna Rodriguez, $636. Then we have a credit to sales of $600 and a credit to sales tax payable of $3,600, and it's sales slip 102. Okay. Now 7 says we issued a credit memorandum 15 to James Palmer for the return of $300 in merchandise plus sales tax of 18. So this is a situation where we're using our contra account because they returned the item. Okay, so we do a debit to sales return allowance. Again, we are not affecting sales. The only time sales is affected is credited. We will never debit sales. Okay, so we debit sales return allowances for that $300. We debit sales tax payable for $18, and we credit accounts receivable in the James Palmer subsidiary ledger for $318. Okay, so here on Anna's, instead of it being a full refund, what happened here is she has a zipper on the ski jacket that's broken, and she agreed to give the creditor $40 credit on her purchase. Okay, so instead of returning the entire item, she just wanted it. She still wanted it even though, and we just gave her credit because of damaged goods. Okay, so we wrote a debit to sales return allowance for $40, sales tax payable for $240, and then we have a credit to Anna's accounts receivable and Anna Rodriguez subsidiary ledger of $42.40.